So also from my side, thank you very much that you are attending today and listening to my talk about building market neutral DeFi portfolios. We heard a lot today about taxes, about strategies, and so on. And now we try to actually put everything together and making some sense out of it. And why am I choosing this topic today? I mean, we have seen a lot of turbulence in the DeFi or in the crypto asset market recently. So I think it's a good point to actually get to know market neutral strategies, what they are, what they try to achieve, and how they are done, and also where the risk are at. And for that, I'm opening my presentation. I hope you can see it. Thomas, if you could confirm that you can see my slides, that would be perfect.
Yes, we can see your screen perfectly. Thank you.
So as I said, today's topic is about building market neutral DeFi portfolios. And we are very thankful that we are able to attend this conference. A warm thank you to Kasuria for letting us present ourselves. It's a great honor and a pleasure. But before we dive deeper into the topic, I would like to present the hurdles momentarily, why, for example, investors do have problems investing into DeFi. And when we look at the hurdles, it's apparent that, of course, we heard about a lot of opportunities in DeFi sector. You can earn yield. It's a very exciting area, and this is true, and this is the case. But currently, investors do have challenges entering the market, actually. And the first hurdle is actually the extremely high volatility. So this is not evident the last few weeks or days. So we have seen a lot of volatility in the market. When we look at the Bitcoin, we can see a maximum drawdown historically of over 83%, and that's a lot. And of course, you can imagine that especially institutional investors, but also retail investors are a bit afraid of this high volatility. Then secondly, the risk assessment is very difficult. Of course, Kasuria is here to help you with that. But in the past, risk assessment was really difficult because in addition to all the financial risks, which are apparent, all the technological risks are coming into place. So we have risks on the asset layer. So what stablecoin, for example, what asset am I deploying actually? Then we have different protocols. We are actually talking about software. So we're talking about code. So this code could be, for example, hacked or fail, or could be purely programmed. So this is really difficult for investors to actually assess the risks for different protocols. And then also we have the risk on the blockchain layer, so the underlying risks. So we have different L1s, we have different L2 blockchains. Of course, there's Ethereum with like the cornerstone, but still, when we look at EVM chains, so chains which build upon the Ethereum network, there are, of course, risks involved. Then thirdly, to really invest into DeFi and to successfully invest into DeFi, because investing is pretty easy, but then being successful is not that easy. You need to be an expert, or you need to at least know how things are done. And especially when we look at the corporate sphere out there, for example, at banks, asset managers, and so on, there are actually no individuals sitting there who really do have a plan of how to investing in DeFi. You cannot generalize that. Of course, there are some individuals who really do have a plan, but when it comes to an overall picture, there are just not enough people with knowledge who can really assess DeFi investments. And last but not least, and Fabian also talked about that, the market infrastructure is pretty complex. So we have opaque regulation. We also heard that when we have talked about taxes. We have a really fragmented investment infrastructure, and if you or yourself have been around DeFi protocols, the user experience is still pretty bad. I mean, just name it by how it is. And what we are now doing at Rudy Capital is that we want to manage all these complexities and along the entire DeFi value chain. So at first, we are doing in-depth market research. So we are looking at all the protocols, at all the assets, at all the blockchains, looking at all the vaults, at all the yield opportunities out there in the market. Then are doing also the risk management for that. So we take the risk really seriously. We have developed a 3-line of defense model, looking at the blockchain, the protocol, and the asset layer. And last but not least, we help clients to construct also portfolios. So we want to generate stable yields, no matter if the market is rising, falling, or trending sideways. And no matter if the market is trending, falling, or trending sideways, that's actually the beauty of market neutral strategies. So therefore, you can achieve stable positive returns even in times of market downturn, as we can see it right now. So as a result, from now on, you can say that stablecoin-based market neutral DeFi strategies can really zero out this market volatility we are seeing right now. And you are then able, if you manage it correctly, you can achieve unprecedented risk-adjusted returns, again, whether markets are rising, falling, or trending sideways. How is that done? So this is really high level here, just to find an introduction. At first, you could use stablecoins. So stablecoins, in theory, they should be stable, of course, but we have seen a lot of stable coins unpegging in recent times. I mean, the most famous example was the UST case. But you could use stable coins, good stable coins. For example, USDC is a really good stable coin from my perspective, to generate these market neutral strategies or these delta neutral strategies. And of course, then market neutral strategies. Just imagine you're deploying or are in a decentralized exchange and you have 2 pairs. So you always are providing liquidity for a certain kind of pair. So imagine the pair USDC, which is a stable asset, and the Ethereum, which is a volatile asset. And you then can hedge the price risk of an Ethereum, of the Ether, to actually make it market neutral. Of course, we are also simulating our strategies, and we could have seen, or we saw that the strategies we were deploying in theory are combining high returns with net zero volatility and also a very low correlation. So let's look at the numbers. So when we look at the volatility with market neutral strategies, you could reach maximum drawdown of under 1%. So you can nearly cancel out volatility as a whole. Then you also are able to achieve strong returns of about 11%. In our case, of course, you can also achieve higher returns, but then, of course, you need to take higher risks. And what we also can see with market neutral strategies, that these are really able to be uncorrelated to digital assets and also to traditional asset classes. So there we achieved a correlation from under 0.01. To give you a bit of more perspective on that, here you can see a simulation. There you can see the Bitcoin as a benchmark and also the S&P 500 in gray. And the purple line is our simulated portfolio. There you can see it's like a straight line, but if you would zoom out, you can see there is some slight volatility. But you can really see in situations where the Bitcoin or the S&P 500 isn't really performing, market neutral strategy in a DeFi place are really able to give you a stable rate of return. How are we doing this actually? Fabian touched on that previously as well. Just to summarize it a bit, so at first, for example, you could generate yield by lending income. So deploying your capital in a lending protocol, you know that from banks, but now you can be the bank and deploy liquidity. Then secondly, you could profit from trading fee income. These are the decentralized exchanges or automated market makers. So you provide liquidity for a certain kind of pair, and you get incentivized with yield by making the markets efficient and by keeping the slippage of trades low. And thirdly, another example would be the reward income. You can think of a reward income, some kind of like a bonus program for using, for example, lending protocols. You may know the Uni token. That's a good example of a reward income. So in addition to your yield, you are receiving reward incomes. But be a bit careful here. Reward incomes or reward tokens like Uni are volatile in nature. So to really make it stable here, you have to exchange these tokens for example, stable coins. And with these three mechanisms, you are, for example, able to generate or to build market neutral strategies. Maybe let me dive a bit more deeper into lending protocols, how this is actually done. So you can see here on the left side, the lender. This could be you, this could be anybody else in the DeFi market. So you provide liquidity, so you deposit crypto assets. In the middle, you can see the DeFi platform. So DeFi platform is not like a firm we know like in the traditional world, so to say, but it's a DAO, for example, so it's code. And on the right side, you can see the borrower. So the borrower is, for example, someone who would like to borrow cryptocurrencies or crypto assets. And now the question arises, why would somebody actually borrow funds on a DeFi platform? Just imagine a very simple case. You are holding a lot of Ether, and your car breaks down and you need money, so real money in the real world to actually fix your car. Then you could go to this DeFi platform, use your Ether as a collateral. So what is really important in the lending sphere is that you always have to over-collateralize your loans. So for example, you give as a collateral, like for example, 10 Ether, and for that you are then able to take back stable coins in the value of 8 Ether back. And then you could use these stable coins, bridge it or trade it to send it to a centralized exchange, and then cash it out for real money, and then pay your bills for your car. And of course, to do that, there needs somebody on the left side here, the lender, who is actually providing this money. And for example, you could provide stable coins and then get like a stable yield for that. Again, of course, there are risks. Of course, you have to take the right stable coin, the right blockchain, and of course, the right protocol to really then generate the yield in the end. Next, I want to show you some exemplary strategies. What is really important here, this is not investment advice, that's just an example. So you always should do your own research on strategies. And this is also very important. So never believe anybody else who is showing you just some strategies out of context. Always do your own research before investing your own money. So my first example strategy would be a simple or quite simple stablecoin LP staking. Here you can see actually the whole process of investing. There's a, so to say, LP staking strategy. So for example, imagine you have 50,000 on your bank account, then you put these 50,000 on your Coinbase account. I mean, more knowledgeable investors use Coinbase, but you could also use the normal version of Coinbase. And then in the second step, you would then exchange your 50,000 euros to 56,000 USDC. So USDC is a well-known stable coin. Then you actually need to escape, so to say, the decentralized world and transfer your funds, so your USDC, to your Ethereum wallet, for example. And then at step 4, actually, like the first DeFi magic happens. Then you deposit 28,000 USDC as a collateral, as we were seeing it in the last page on Euler Finance and Iron Bank. These are just another protocols. And then you borrow. For that, you borrow another fund. So you borrow then, for example, AG Euro or IB Euro. These are another stable coins. We are borrowing then, and then we deposit these stable coins into a curve pool, so in the AG Euro, IB Euro LP curve pool. And then we are staking these curve LP on Convex. So you see the time is actually not sufficient to really go into depth here in these strategies. So you see it's really complicated to actually deploy market neutral strategies. And if you would like to learn more about these, so I will show you two more. But if you are really interested in these, just shoot me a message on LinkedIn, for example, and I'm happy to assist you and explain you into more depth. Then another strategies would be a leveraged stablecoin lending strategy. So you're really leveraging it, as Florian told you before. So again, step 1 and step 2 are the same. So again, you are then at step 3, where you then transfer your USDC to your Avalanche wallet. So you're using then the Avalanche blockchain, and then you're depositing your USDC into an Aave lending pool. And again, then you're using this LP token you're receiving as a receipt that you have lended it out. You're using this as some kind of a leveraged or as a token to actually then borrow other funds. So you then go to Yeti Finance and borrow YUSD, and then you use these YUSD to actually deposit it into Vector Finance to then generate a stable position. Why are we using YUSD at first hand? Because USDC is a very safe stable coin, and if we borrow the stable coin, we are also we are hedged internally, so we are not really correlated to the value of YUSD. So we have some hedging in place. Then let's come to the most complicated strategy. This is called the impermanent loss hedge strategy. So impermanent loss is a very difficult scheme to understand in DeFi. I will come to that later on. I will recommend you some articles written by us to really understand this. But if you deploy capital on a decentralized exchange, you're always getting a token back. And this token always represents some kind of a ratio you were deploying. And if the assets in this pool are then differentiating in value, then it could be the case that you're actually losing money. And for that, also in market neutral strategies, you have to hedge against that. So you hedge, for example, with a short position on FTX, and then try to squeeze a zero. This sounds right now really complicated. As again, I'm really sorry that I'm not able to go into detail here, but we have documented everything on our website. So you are mostly welcome to dig into it a bit more deeper. Of course, when we look at market neutral strategies, we also have to talk about the risk management. And as I told you, it's always a combination of blockchain, DeFi protocol, and asset risks. And how do we manage this actually? So at first, we have our own Rudy stability score. So that we manage the smart contract risk, the financial risks, and the centralization risks. So for example, a risk on the smart contract side would be how long the protocol is on the mainnet. Are there any critical vulnerabilities apparent in the past? Is there, for example, a bug bounty on the protocol, or has there been a public audit? When we look at the financial risks, we look at the absolute liquidity of a protocol. We look if there is a collateral makeup. If yes, how high the collateral makeup is. And we also look at the utilization ratio of certain kind of lending pool. And last but not least, which is also really, really important and really important to look at when we actually deploy capital in the DeFi, is the centralization risk. So what team is actually behind these protocols? Are the team members known? Is there a website? Are these members of a DAO? Are they deploying other protocols on the market? Are these protocols safe, for example? And also then we look at the oracles, so the price feeds. And then again, to hedge actually, to hedge against a price risk of a stablecoin, for example, you are able to use decentralized insurances. For example, you could close a DPEG cover, a protocol cover, and a custody cover. Of course, this is not for free. You could estimate a cost for such an decentralized insurance of about 3 to 4% per year per position value. Maybe again to example the investment process. So you have the strategy pool, then the strategy pool goes into a risk and return assessment. Then you check for example, in our case, for over 50 qualitative and quantitative metrics. So we look at the smart contract risk, we look at the centralization risks, we look at the sentiment, but also really important at the return stability, because in DeFi, stability or returns aren't always ensured. So you could see today a lending pool which is giving 30% of yield, but tomorrow it could be only 2%. And then we calculate a risk return score, and from there we are then building our simulated portfolios, and then we put there our 12 to 15 best strategies in our simulated portfolios to then really see if our risk management and our strategies are actually working. To actually get a bit more deeper in everything we are doing, I invite you to look at our articles on Medium. So there are 2 articles which are fitting quite well for the recent times. So one article is about how to not slip into death spiral, hedging the USD DPEG. So there we actually describe how you could have hedged against the UST DPEG, but this is also a good example for other stablecoins. And secondly, we talk about hedging the impermanent loss I was talking about earlier. So to do so, just go to our LinkedIn page or just browse to blog.rudy.capital to see these articles. Again, if you want to learn more, just contact me, visit our LinkedIn page, our website, rudy.capital. And thank you very much. It was a pleasure being here. And if you have any questions, just shoot them to me. Thank you very much.
Thank you, Philipp. I think that was a great presentation, a well thought out strategy that you presented. If you have time, there was a question from the audience for you. I'll just read it out. Until what point a strategy would be high risk using different protocols? Your example number 1, and how do you measure this?
Mm-hmm. So you actually cannot give a general answer for that. So it really depends on the market situation. And also we're talking about software, and software always is changing. So you always have to look at the protocol at real time to really assess a daily risk score. I don't know if this the right direction of the question, but maybe can you elaborate a bit more in the chat if it was the answer to your question?
Okay, thank you. And one other question that I had here is, what client segment, so which investor type would you see as an early adopter for some of the strategies that you just presented?
Mm-hmm. So what we can see, of course, high net worth individuals who really do have money to really, try the DeFi ecosystem. But what we can see right now, and this is really interesting, that private banks, also German private banks, are starting to actually tip their toes into DeFi. And then, of course, asset manager, for example, especially the small ones are starting. But this gives really an outlook that the big players aren't behind, and they will start to dig into DeFi soon as well.
Interesting. What would be the minimum account size to make a reasonable portfolio?
So again, I mean, it really depends on the assets you are using. But the beauty of DeFi is that there is really no minimum investment. So you could really start and deploying a market noodle strategy with only $100 or even $10. Of course, $10 on the Ethereum blockchain is not a really good idea because you have gas fees. But if you go on, for example, L1s or L2s, for example, Phantom, the historic gas fees are pretty low. So I would say starting with $50 to $100 is actually enough to really start. And that's the most important point.
Okay. Thank you very much. So